Wait, what? Budgeting money? That sounds boring. No, painful. I'm a doctor, after all, and I deserve it. The house, the car, the vacation, whatever. My credit card still works, right? How much is enough? For now? For later? For retirement? I keep hearing about all these different insurance things and wonder if they're necessary. Regardless of whether talking about limits and margin with money makes you want to fight me, or if it makes you want to snooze because you think it's boring and unnecessary, stick around for the rest of the episode to hear how aligning your priorities and your finances can allow you to pursue your wellness today. Welcome to the MedEdWell podcast, where physicians get empowered to take the next step in their wellness, personally, professionally, and financially. I'm your host, Dr. Ryan Stegink, a practicing general pediatrician and online entrepreneur. Thanks for joining me again today, here on the 5th episode of the MedEdWell podcast. Today, I'll be covering the second part in the series on margin, moving from time to money. We will cover why margin with money is helpful, and yes, even talk about budgeting. Priorities and planning don't have to be such a downer when you realize they allow you to live your life with intentionality and in line with your priorities. Your continued engagement with this podcast has been encouraging to me, and please continue sharing with other physicians and students in your life. And speaking of sharing with others, for those of you who work with residents and fellows, there is a free webinar I'm doing soon called Financial Wellness and Training. In it, I will cover a lot of topics from today with more of the why behind them. More specifics about different types of retirement and investing accounts, disability insurance, basic concepts around student loans. The link to register is in the show notes. Now, speaking of student loans, let's briefly hear from today's sponsor. Do you have mortgage-sized student loans? Are you confused about how to manage your student loan debt and ensure that you are following the right plan? Or just want reassurance that you're on the right path? Today's sponsor, StudentLoanAdvice.com, was created to provide you with the best solutions to manage your student loans. Create a customized student loan plan today. For more information and to schedule an appointment, visit StudentLoanAdvice.com/MEW. The link will be in the show notes. And now, back to today's show. So for me, my journey with money in medicine started back in medical school. You fill out all the FAFSA forms, register for classes, then you get this financial aid award. An award. What an honor. Awards are free, right? Well, not this one. It says, here's the money. It's a loan, and these are the terms in a big document called the Master Promissory Note. And here you go. You kind of have an idea from the tuition, fees, typical expenses for different things. You can take all the money, or you can specify that you want less. But then that's pretty much what you get for the semester. There were some ways to give back a little extra if you took too much, but you had to do that in a certain time frame. I was thankful to be accepted to my in-state medical school. But when your home state was at least $100 million behind on support for the university, then your medical school tuition, despite being the cheapest that I was able to get, was still the 5th highest state school tuition in the nation at the time. So naturally, loans for school force a certain amount of planning. Well, at least they should. In college, I was blessed with a few scholarships and generous assistance from my parents. But now in medical school, I was taking out these huge loans. Wow, that's a lot of money. But that's just what you do, right? I heard of a few people working during medical school, but for the most part, med school is your job. You're working hard studying, preparing, and caring for patients. So figuring out what I needed for finances, I realized that in my situation, I was able to take less than the maximum offered in terms of my loans. I had roommates each year, I used the public transportation card that was already included in my semester fees. My parents generously let me borrow one of their cars for a while on some of the rotations, and yet, even making a spending plan for the semester so that I didn't run out, money just keeps rolling in. I didn't quite comprehend the psychology of all these loans, the weight, the size of the loans, and the time that they were going to sit there growing. 4 years allows you to become immune to how big it really is. And then when you enter repayment, you're like, what? The income-based payment in residency probably doesn't even cover the interest accruing? So then, out of medical school, I enter residency and repayment. My loans are all federal. I don't know to consolidate and skip my grace period, but at least I'm started on an income-driven repayment plan and get on the public service loan forgiveness pathway. And yes, my income-based payments do not even cover the interest accruing, and as I saw in med school, the balance just continued to rise. But now as a resident, there's a paycheck coming in. Sweet. But where does it all need to go? Thankfully, I found a reasonable apartment to rent in residency, and I attended the orientation session on our benefits package, health insurance, and retirement options. As an aside, budgeting is another way of saying making a spending plan, cash flow planning, whatever you want to call it, but it's the same thing. For me, tithing and giving outside myself was a priority, and I knew to try to save some as well. Giving helps fight the illusion of control, saying that whatever I am giving to is of higher priority than what I could otherwise spend that particular money on. It doesn't mean those other goals aren't important, but it may mean it takes a little longer to get there, whether a vacation, retirement, or some other savings goal. It's again about priorities and planning. So on the savings side in residency, having just learned about the Roth IRA and 403b at that orientation session, I tried to take advantage, especially as some of those could reduce my income for the loan payments. Beyond just the giving and saving for retirement, I tried to build up an emergency fund. What I eventually learned should be in the range of 3 to 6 months of expenses. Some people would say you could use a credit card with no interest for a particular time frame. Others would say if you have some equity in your home, you could take out a home equity line of credit. Or if you have a taxable account, you could sell some of your holdings. But those come with their own delays or risks, high interest rates on credit cards, time delays, or facing undesirable capital gains consequences. So there's room for differences of opinion, but having 3 to 6 months of expenses in a high-yield savings account or something similar allows you that hedge, some margin. For a large medical bill, a car repair, an air conditioning unit, or perhaps an unexpected furlough or a drop in patient volumes when, say, a pandemic totally reshapes and affects the landscape of medical practice. That money in your emergency fund is not sitting around doing nothing, especially when there's a low interest rate environment at the time of this recording. No, it's self-insurance for yourself, money with a job, hard at work, just not focused on the rate of return. Speaking of giving money a job, let's take a moment to talk about the mechanics of planning, the nuts and bolts of making your budget. Wait. Making your spending plan, how to spend your money. The difference may seem small to many, but I think that for me, staying on budget sounds more restrictive than this is a plan for how I, and now my family, spends money. It's saying this is the job for this money, and if it's gifts for others or vacation, we're going to enjoy those things together. So back to the specifics. This can be done on paper, on a spreadsheet, or using a particular program. I previously used Quicken and now use You Need a Budget, or YNAB. There are lots of other digital options out there as well. Try a couple, and then just get moving forward. More money coming in than going out creates that margin to move forward on your financial goals, even if that means paying off credit card debt or getting that emergency fund started. It could also be moving towards financial independence, whether you want to retire early or just have goals for where you want to be financially when you do retire. Seeking to maintain some of that margin allows you to align your financial goals with your values and priorities. There are a variety of categories that you'll have to include, starting with housing. In residency, I rented before and after getting married, knowing that we might end up moving. I've heard 3 to 5 years of appreciation of a home typically equals about the costs of buying and selling a home. We didn't know where life would have us in the long run, and life hasn't been the straight road we thought it would be. We ended up renting an apartment longer than we might have, going on 6 years now, prioritizing income-based loan repayments and side savings in case loan forgiveness doesn't work out. I have colleagues who've bought in residency and were very happy with their decision, but this is part of personal finance being personal. So housing is one thing, and then there's transportation as a category in your spending plan. You can choose what you want to prioritize, but in residency and early career, this may be where you hold on to a vehicle a little longer, not get the brand new version, or not go for the big splurge right away. You may have something else you want to prioritize more than that. When I started residency, I had some money saved up for a car, and I paid cash for a Ford Focus that was 4 years old and 80,000 miles. It has had its issues, but it's been paid off since the beginning. No car payment. I disagree with Dave Ramsey, and others would say no debt at all. Like I said earlier, med school is not something you can cash flow. Working a regular job that would cover tuition just wasn't happening for me. But I personally tried to limit things I would take on debt for. This would be for a house and education, again, both within reason. Yes, I know people do this often for business opportunities, but that hasn't been my background previously, and there are many other physician entrepreneurs who can speak on this if you're considering these opportunities. I use credit cards like cash, paying them off every month. And like I tell my patients with their healthy habits, no shame if you haven't used credit cards in the ways that you'd hoped. Just take that next step forward. Credit card debt, if there, should be one of your highest priority savings goals. You're essentially getting a guaranteed return of whatever the interest rate would have been, 15, 20, 24%, or whatever the terms of your card are. All of this doesn't mean that you can't choose to splurge on something, but you have less margin going into those decisions if you're in residency or have a lower income, or if you have large commitments already established that would be even more difficult to change. True own occupation disability insurance also needs to be on your list. The portable, take it with you kind of policy. Yes, it isn't cheap, but there is the ability to purchase some while you're in training and add a future purchase option rider, among others. These additional riders include, but are not limited to, partial disability and cost of living adjustments. Getting a policy in residency or fellowship often allows you to have a guaranteed standard issue policy where they don't look at your underlying medical history, just whether you have been denied for insurance previously, which means that for medical students, typically without an income to protect, probably don't need this type of insurance. Term life insurance is separate and something to consider if someone's depending on you or your future income, say a partner, child, or other family member, just not disability insurance until residency or after. There are 6 companies as of this recording that offer true own occupation disability policies, and an independent agent will allow you to comparison shop them. There's a link to one in the show notes, but there are multiple options out there. And while we're on insurance, disability insurance is expensive because it gets used. Cancer, car accidents, extended illness, lots of things can cause disability. Most policies have a 90-day waiting period, so that's something for the emergency fund we talked about earlier. Insuring your vehicle, particularly for liability, is also important, since even if you are just a resident, if you are in an accident and someone figures out you're a physician, all the more likely that you might need to use that policy. Also, home or renter's insurance, umbrella insurance for additional liability above the limits of your home or auto policy, these are all things worth looking into. Again, creating margin in your budget is important for these things. You may look at discretionary items, whether dining out, TV subscriptions you have, vacations, or otherwise. It's not because having all this insurance is so fun, but because life happens. And having these things in place maintains your ability to pursue your other goals when these things do come up. It also means that if one of these discretionary things brings you a lot of joy, you pick something and plan around it, rather than realizing you have no money left for your car insurance because you spent it on dinner last week. And then there are the loan payments. First, private loans, refinance them into a lower rate if you can. For federal loans, depending on your debt and your income, you may need a partial financial hardship to qualify for certain income-based plans. Those of you who are married may need to look at married filing jointly versus separately if you're planning to go for public service loan forgiveness, while those of you with higher incomes relative to your debt level may need to consider refinancing as well. However, making the wrong move can be disastrous for your personal finances and often with no ability to go back. One example would be refinancing federal loans when you work at a nonprofit institution in residency and beyond, and would otherwise potentially qualify for public service loan forgiveness. I ran the numbers myself going through it and stayed on the pay-as-you-earn program for my payments, including a couple years of married filing separately. By doing so, the loan payments decreased by excluding my wife's salary, which outweighed the increase in taxes from filing separately. This would not have been possible in the revised pay-as-you-earn program, REPAY, and married filing separately also didn't make sense based on her income and mine once I had a full year out of residency. Complicated? Definitely. But for significantly less than a typical income-based payment after training, StudentLoanAdvice.com is a company that specializes in helping you walk through your options for your loans. This particular opportunity wasn't there when I was making these calculations. It could help bring clarity to the decision for you, particularly if these calculations or spreadsheets aren't your thing. These are some of the nuts and bolts of different things that I've learned from making a spending plan for me, and this is not financial advice. However, I hope this spurs you to consider some of the big categories in your own budget. But now to the why. Why do you want this financial margin? And what can you do with it? For me, margin meant I could cut to 0.85 FTE when I was burned out. It meant that when my wife, who is a nurse, wanted to go supplemental status to care for our daughter and greatly decrease her hours at work, she could. And having shared those decisions as a couple, we both are able to stay engaged personally at home and professionally at work with colleagues and patients. My wife also has the flexibility to pick up additional shifts as she wants, which means more daddy-daughter days. But our household budget with shared finances is not dependent on those extra shifts. Being married, my wife and I have chosen to do shared finances. We talk budget categories regularly, where some may need to increase over time, especially with a kid and changing life seasons. We also have a certain amount of fun money that's allowed us to have a lunch out with friends or, say, invest in a podcasting setup. By doing this, we can do some of these fun other things without having to worry about where we need to put that in the budget. We've also figured out that some extra margin in our budget gives us the flexibility to get something new for our place, either a new decoration or a new microwave when that one breaks. It also gives flexibility to do other things in line with our priorities. My wife and I both have prioritized giving, but my wife has helped me see more of the tangible needs of others around me. And so, if a friend has a new child, or a colleague has a significant illness, or there's a chance to bring someone a meal, we have the opportunity to meet that need. We have been on the receiving end of assistance and meals in the past as well, and it is a big encouragement. Some of your priorities will look different than mine, but this is part of how I've processed ours. We didn't get into how much to save and where, but know that just because we didn't cover it here, number one, it's definitely important, and number two, we will come back to it more in future episodes. So one side is the spending, which I had significantly more experience managing in medical school and beyond. The other side of the equation is the earning. This could be your main gig, a W-2 position, employed, 1099 as an independent contractor, private practice or otherwise, or other business opportunities or investments, whether stock market, real estate, or others. You could also be starting your own business, and some other physicians are doing great work in coaching and providing value to budding physician entrepreneurs. Know that your current job doesn't have to be your forever job. Market rates for a particular specialty vary regionally, and the cost of living and other considerations come into play, whether you're going for public service loan forgiveness and need to be at a nonprofit institution. Lots of factors can affect your earning potential, even within your own specialty. As an employed physician, I have a regular salary with an occasional additional amount that I've earned above the base maybe once or twice a year. In making a spending plan, I didn't expect those additional amounts, treating bonus as bonus. This has created additional margin for me on the inflow side of planning. So as we wrap up today's discussion of margin and finances, if you don't have a spending plan, go make a budget. It may be that you start by looking back at the past 3 to 6 months to see where your spending has been. Look back a year as well for some of those episodic expenses, birthdays, holidays, annual insurance payments. If you do have a budget, look at whether your spending aligns with your priorities. Then I want you to pick a next step that needs to happen to move forward financial wellness for you. It may be freeing up margin by considering what may not be essential that could allow you to eliminate that credit card debt, save more for retirement, give more to others, or go on that nicer vacation guilt-free because you saved up for it. Or is your next step in your financial wellness to sit down with your department head and discuss how you've been outperforming your contract and how your base salary needs to be increased based on your production? Or is it that you need to apply for similar positions in your area so that you have other offers to better renegotiate your current position, or that you have the flexibility to be able to move jobs to increase your salary? Or does it mean scheduling a student loan consult with today's sponsor, studentloanadvice.com, at the link in the show notes? Whatever your next step is, knowing where your money is, where it's going, and creating margin financially gives you more options to pursue wellness for yourself, whether a particular goal you have in the short term or some other use for it that aligns with your priorities. Find the time, decide what to do with it, and create the financial margin to make it happen. If you enjoyed this episode, please take a moment to share with another physician, subscribe to the podcast, and leave a review. Again, thank you so much for joining me here on the MedEdWell podcast, and have a great day. And now for our important disclaimer. Dr. Ryan Stegink is a practicing general pediatrician, but the MedEdWell podcast does not reflect the views, opinions, or belief of his employer nor his affiliated university. Additionally, the MedEdWell podcast is for educational and entertainment purposes only and should not be considered advice regarding financial, legal, student loan, medical, or any other specific topic. In such a case, you should seek consultation with a certified professional in that particular area. Again, thanks for joining us on the MedEdWell podcast, and have a great day.